Welcome to Goldstone Finvest. I am Prabhat Majumdar. I will share today's market update. Today, dovish commentary from the US Federal Reserve led to strong gains in the opening session on D Street before the spike in US bond yields led bears take control. The US 10-year Treasury yields rose to 1.74%, their highest since January 2020. Analysts observed that for Nifty, 5 consecutive days of fall could put anyone in doubt about a bull market that had pushed Sensex beyond 52,000 and Nifty above 15,400 levels just last month. The relentless selling pressure on highs dragged Sensex below 50,000 while the Nifty breached crucial support near 50 DMA and 50 days EMA on Thursday. Let's look at the final tally on D Street. The S&P and BSE Sensex fell by 585 points to 49,216 points, while the Nifty closed 163 points lower at 14,557. It was seen that today, on the day of expiry, the market started the day on a strong note and positive global cues after Federal Reserve signaled it was in no hurry to raise interest rates but gave up all gains in the second half and lost over 1% after US 10-year Treasury yields hit their highest level in 13 months. The sell-off was more prominent in the broader market space. The S&P BSE Midcap Index fell by 1.3%, while the S&P BSE Small Cap Index was down by 1.58%. Experts saw that the Indian equities pared its early optimism and fell into a sharp correction as US bond yield rose to their highest level since January. Dovish comments from the Fed chief on the strong economic bounce back and continuation of its accommodative stance could not weigh down the rally in the US bond market. Indian markets had witnessed higher volatility compared to its global peers as domestic investors turned extra cautious on increasing COVID cases in India and a fall in FII inflows. Caught in the selling pressure in the last hours of trade, the Nifty broke the 50-day exponential moving average EMA to close 1% lower. Rising US bond yields, which climbed above 1.7% after the Federal Reserve meeting, dented market sentiment. Our experts said that the index ended in the red for the 5th consecutive session and formed a bearish candle on the daily charts as closing was lower than opening levels. The Nifty has to rebound above 50 EMA to get in a strong mood. Detailing the study, researchers observed that the Nifty opened sharply higher at 14,855 and extended gains up by 14,875 only to wipe them all out in the afternoon to slip to the day's low of 14,478. The index settled at 14,557 with 163 points. The Nifty formed a strong bearish candle on daily scale and weakness continued for the 5th consecutive session with the formation of lower highs. India VIX was down by 0.40%. A decline in VIX even after the sharp correction is not giving any immediate clues. Experts said that the index decisively breached its 50-day exponential moving average, whose value is placed around 14,613 levels with a wide trading range of 397 points. Hence, unless it conquers its 50-day EMA with a sustainable close, any bounce towards the said average shall remain vulnerable for a sell-off in the near term. On the downside, it seems to have neared the critical support placed at 14,469 to 14,336. Any further extension of a downswing shall ideally attract some buying interest in the said zone, they said. Moreover, with 5 consecutive negative closes from the highs of 15,336 levels, the market might have reached some sort of oversold levels, which should ideally pave the way for some relief rally as it nears the critical support zone. Looking on the options data indicated that the Nifty could keep moving in a wider trading range of 14,300 to 14,900 levels in coming sessions. On the options front, maximum put open interest was seen at 14,000 followed by 14,000 strike, while maximum call open interest was seen at 15,000 followed by 16,000 strike. Call writing was seen at 15,000 then 14,800 strike, while put writing was seen at 14,200 then 14,100 strike. The Bank Nifty opened positive at 34,577 and hit an intraday high of 34,759, but banking stocks failed to hold and the index breached 33,600 levels to hit the day's low of 33,597. Experts recorded that the index has been underperforming the Nifty for the last few sessions and ended the day 372 points lower at 33,856. It has been making lower highs from the last 4 trading sessions and formed a strong bearish candle on the daily scale, indicating a tight bear grip. Researchers suggest that if the Bank Nifty remains below 34,500 levels, weakness could be seen towards 33,500 and 33,333, while on the upside, key hurdle is seen at 34,750 and 35,000. Sectorally, the S&P IT index slipped by 3%, while healthcare, power, realty, bank and capital goods indices shared over by 1% each. Among sectors, IT index shed 3%, pharma index fell over 2% and PSU bank index declined by 2%. BSE mid cap and small cap indices shed by 1% each. What experts are suggesting traders should do on Friday? Till the Nifty remains below 14,700 zone, weakness could be seen towards 14,450 and 14,300 zones, while on the upside, hurdles shift lower to 14,800 and 14,900 zones. The Nifty formed a strong bearish candle on the daily scale and continued its weakness for the 5th consecutive session with the formation of lower highs from the last 4 trading sessions. Policymakers have confirmed that there will be no hike in the rates, and that has come as positive news for the markets globally. The market couldn't sustain the higher levels due to looming threats around the uncertainty about the lockdown. Asian markets have also been turned negative after the initial positivity in the market. Global sentiments continue to be positive and we can expect a reversal in the next week. As of now, the short-term technical condition to be in the range of 14,410 to 14,900. All major indices are trading in the red. The market failed to show resilience to stay above the level of 14,750. As of now, the short-term technical condition of the market shows that the expected range of the market is likely to be between 14,410 and 14,900. While it is subject to further price action evolution, it is prudent to wait for volatility to subdue and technical factors to improve before attempting to build short to medium term investments. We retain our cautious stance until further improvement and breakout is seen above 14,900. With the US 10-year yield hitting its highest level in over a year, bears held the upper hand on Thursday even as the Fed kept rates unchanged. Selling in financials kept markets in the red, with broader markets selling profit booking in IT and pharma stocks ahead of the FTSE rebalancing on Friday. As stated by Goldstone experts, traders should trade extremely cautiously with strict stop losses and should follow support and resistance levels on strict basis. Considering the oversold nature accompanied by the nearby support zone, traders should remain mere spectators by adopting a neutral stance in the next trading session. Follow support and resistance levels along with trading call as published on our Telegram channel. For regular updates, like, share and subscribe our YouTube and Telegram channel. Follow us on Twitter and Instagram and also be a part of our Facebook family. Views by Goldstone Finvest. Let's build fortune together.